most retail traders lose money. In fact, studies show that 90% of retail traders lose money. 90%. That's more people losing than winning. And here's the crazy part, they're not losing because they're stupid. They're losing because they're breaking one simple rule. One rule. And almost nobody talks about it. This rule has been used by the biggest hedge funds in the world for decades. Wall Street insiders know it. Billionaire investors use it. But somehow, this rule never makes it into the YouTube trading videos you watch. Never. It's like it's hidden in plain sight. But the truth behind this will absolutely shock you. Here's what we're covering today. First, we're going to show you exactly why 90% of traders are failing and it's not what you think. Second, we're diving deep into the one rule that separates the winners from the losers. And third, we're revealing how you can start using this rule today, even if you've never heard of it before. Some of you watching right now have already lost thousands of dollars, maybe tens of thousands. And if you keep trading the way you're trading now, you're going to lose more. That's not being mean. That's just being honest. But here's the good news. By the end of this video, you'll understand why that happened. And more importantly, you'll know exactly how to stop it from happening again. Let me show you exactly how this all happened. So let's start at the beginning. Back in the 1970s, a group of mathematicians got into the stock market. Not because they wanted to be rich, well, maybe a little bit, but mostly because they looked at the market and saw something nobody else was seeing. They saw patterns. They saw numbers, data. These mathematicians started working at big banks and hedge funds, and they started making money. A lot of money. They weren't trading like the guys in the movies, screaming on the phone and making gut decisions. No. They were using math. They were using formulas. They were using computers which were brand new back then. By the 1980s and 1990s, these mathematicians, people called them quants, were running huge parts of Wall Street. They were managing billions of dollars, literally billions. And most of them were making money consistently, year after year. Not sometimes. Consistently. Now here's where it gets interesting. These quants had something that regular traders didn't have. It wasn't better instincts. It wasn't secret information. It was something much simpler. Something that anybody could learn. They had a system. A real system. Not a guess. Not a feeling. A system based on rules. But when the internet came, everything changed. Suddenly, regular people could trade stocks from their bedroom. No fancy education needed. No expensive computers. Just a laptop and an app. And that's when things got weird. YouTube channels started popping up. Trading coaches started charging thousands of dollars for courses. Everyone was telling regular people that they could get rich trading stocks. And some of those people actually believed it. They opened accounts. They started trading. And most of them lost money. But here's the thing that nobody noticed. The quants were still making money. The hedge funds were still making money. Wall Street was still making money. Only the retail traders, the regular people trading from home, were losing. So what was the difference? Why were the professionals winning while the amateurs were losing? Everyone assumed it was because the professionals had better information, or better technology, or they went to fancy schools. But that's not it. Not really. The real difference was this. The professionals had rules. They followed systems. They didn't trade on emotion. They didn't get excited about a stock and buy it. They didn't panic when they lost money and sell everything. They followed rules. And the retail traders, they had no rules. Well, they had some rules, but not the important ones. They had rules about which stocks to buy, but they didn't have rules about when to stop. They didn't have rules about how much money to risk. They didn't have rules about what to do when things went wrong. Now here's where things get really interesting. The first big discovery is this. The rule that separates winners from losers isn't about picking the right stocks. It's not about timing the market perfectly. It's not about finding the next big company before everyone else does. No. The rule is about something totally different. It's about risk. Specifically, it's about something called position sizing. And position sizing is literally the most important thing that retail traders ignore. Like, completely ignore. They don't even think about it. Let me give you an example. Let's say you have $10,000 in your trading account. You find a stock that you absolutely love. You're convinced it's going to go up. You're really sure about this one. So what does a retail trader do? They put all $10,000 into that one stock. Or most of Italiano, maybe $9,000. Now, if that stock goes up, they make money. They feel great. They tell their friends. But here's what happens when that stock goes down. And they all go down eventually. When it drops 30%, they just lost $3,000. Their account went from $10,000 to $7,000. Datese, uge, that's a 30% loss on their total account. The professional made $6,000. The retail trader lost $1,700. Same market, same stocks, different rule. This is the rule nobody talks about. Now let's go deeper. Because understanding position sizing is great, but understanding why it works is even better. And this is where it gets really interesting. There's a concept in investing called expectancy. Expectancy is basically this. Over many trades, how much money are you going to make on average? And here's the crazy part. Your expectancy can be positive even if you lose more trades than you win. Yes, you read that right. You can lose more often than you win and still make money. This absolutely blows most people's minds. Let me show you why. Let's say a professional quant trader has been backtesting a strategy for 5 years. They looked at 5 years of historical data and ran their trading system on it. Here's what they found. Out of 100 trades, they won 45 trades and lost 55 trades. They win less than half the time. But get this, their average winning trade makes $400. Their average losing trade only loses $150. So let's do the math. 45 wins times $400 each equals $18,000 in profit. 55 losses times $150 each equals $8,250 in losses. Net profit is 18,000 minus 8,250, which is $9,750. They made almost $10,000 while losing on 55% of their trades. This is the opposite of what retail traders think. Retail traders think you have to win most of the time. They think you need to pick winners. But that's not true. What matters is how much you win versus how much you lose. But here's where it gets even more interesting. This expectancy number, this 9,750 on 100 trades, that's the most important number in all of trading. If your expectancy is positive, you will make money over time. It doesn't matter if you have a bad week or a bad month. Over a long enough time, you will make money. But if your expectancy is negative, you will lose money. It doesn't matter if you have a good week, you'll still lose eventually. And most retail traders have negative expectancy. They're playing a game where the odds are against them. They might get lucky for a month or two. They might win some trades, but eventually the math catches up. And they lose. Now, here's the craziest part. A lot of retail traders don't even know their own expectancy. They don't track their trades. They don't write down whether they won or lost. They don't record how much they made or lost. So they have no idea if their strategy actually works. They're just trading on feelings. The professionals are different. The professionals know their expectancy before they risk a single dollar. They backtest their strategy on historical data. They run it through computer simulations. They know exactly what to expect. But there's another layer to this, and this is where the quants really separated from everyone else. After they figured out their expectancy, they figured out how to maximize their returns. And they did this through something called the Kelly criterion. The Kelly criterion is a mathematical formula that tells you the perfect position size. It tells you exactly how much money to risk on each trade to maximize your long-term profit. And it's beautiful because it's based on pure math, not opinion, not feeling. Math? The basic formula is simple. If your win rate is 60% and your average win is $400 and your average loss is $150, the Kelly criterion will tell you exactly what percentage of your account to risk. And for most successful traders, this number is between 1 and 3% per trade. 1, 2, 3%. Das Italiano. That's the secret that Wall Street uses and retail traders ignore. But here's where it gets even better. Once you know this number, you can actually predict how long it will take you to double your money. It's not a guess anymore. It's math. Some professional traders can double their account in 2 to 4 years if they follow the Kelly criterion with a positive expectancy strategy. Meanwhile, retail traders are hoping to double their money in a month. They're taking huge risks. They're breaking the rules, and they're losing. Now, you might be thinking, okay, so I need to know my expectancy and use the Kelly criterion. But how do I actually find a strategy with positive expectancy? This is where most people get stuck, because finding a good strategy is hard. It requires backtesting. It requires data. It requires time. But here's what's amazing. Some of the most profitable strategies are actually really simple. They're not complicated at all. They read things like buy when the stock goes above its 200-day moving average, or sell when the relative strength index is above 70, or follow the trend. Really basic stuff. The reason they work isn't because they're smart or complicated. It's because they follow the rules. They have consistent entry points. They have consistent exit points. They manage risk. They let winners run and cut losers quickly. They're not trying to predict the future. They're just following the rules. And here's the thing. Once a simple strategy works, you don't need to find another one. You don't need to find the perfect strategy. You just need one that works. One that has positive expectancy. And then you follow it. You follow it consistently. You don't second guess it. You don't try to improve it every week. You just follow the rules. This brings us to the most shocking discovery of all. Most retail traders fail, not because they're dumb. They fail because they're trying too hard. They're looking for the Holy Grail. They're looking for the perfect strategy that never loses. They're looking for the magic indicator that always works. And because they're looking for something that doesn't exist, they keep changing their strategy. They keep trying new things. And that's the kiss of death in trading. Let me tell you a story. There's this famous trader named Ed Sakota. He's a legend in the trading world. Made hundreds of millions of dollars. And you know what his trading rules are? They're simple. Incredibly simple. Most people would look at his rules and say, that can't be right. That's too simple to make money. But he made hundreds of millions of dollars with those simple rules. Why? Because he followed them. He didn't get bored with them. He didn't try to improve them every week. He didn't doubt them when they didn't work for a month. He just followed the rules. And here's what most retail traders do wrong. They do the exact opposite. They follow a rule for 2 weeks. If it doesn't make money in 2 weeks, they change it. They try a different strategy. They think the old one stopped working, but they don't realize something critical. Most trading strategies have drawdowns. A drawdown is when you lose money for a while. It's a bad streak. Every strategy has them, even the strategies used by billionaires. Warren Buffett's strategy has drawdowns. It might go 6 months or a year without making money, but over 10 years, it makes money. The problem is that most retail traders only stick with a strategy for a few weeks. A few weeks, and every strategy will have ups and downs over a few weeks, so they always quit right before the strategy starts working. This is actually one of the most important discoveries in all of trading. It sounds simple, but it's absolutely critical. You have to stick with your strategy long enough for it to work. You have to go through the drawdowns. You have to believe in the math even when it's not working right now. Let me give you specific numbers. Professional traders typically require 6 to 12 months of historical data before they even start trading a new strategy. 6 to 12 months. They want to see how it performs through different market conditions. They want to see it win and lose. They want to see the drawdowns. And only then, after they've tested it thoroughly, will they start risking real money. And even after they start risking real money, they only risk a small amount at first. They might backtest a strategy on historical data, see that it makes money. But they know that real trading is different from back. So they start with maybe 50% of the position size they calculated. They see if the strategy works in real trading. And only after it works in real trading for a few months will they go to full position sizing. That's called forward testing or paper trading. And it's critical. It's absolutely critical. But most retail traders skip this entirely. They watch a YouTube video about a strategy on Monday. They open a trading account on Tuesday. They start trading real money on Wednesday. And by Friday, they've lost money and they're looking for a different strategy. This is insane when you think about it, but it happens all the time. So here's the revelation that changes everything. The traders who make money consistently are not smarter than retail traders. They don't have a secret indicator. They don't have insider information. They simply follow the rules. They backtest. They forward test. They know their expectancy. They know their position size. They follow their strategy even when it's not working for a few weeks. They understand that making money in trading is not about finding the perfect strategy. It's about following a NY strategy that works consistently for a long enough time. That's it. That's the secret. There's no magic. There's no hidden knowledge. It's just discipline. It's just following the rules. But wait. There's more. And this is what really separates the professionals from everyone else. Professionals understand something called compounding. Let me explain. If you start with $10,000 and you make 20% profit in the first year, you now have $12,000. If you make another 20% in the second year, you don't have $14,000. You have $14,400. Because that 20% is calculated on the new amount, $12,000, not the original amount. This seems small, but over many years, it's massive. After DS years of 20% annual returns, starting with $10,000, you'll have about $61,900. That's 6 times your money. After 20 years, you'll have over $380,000. After 30 years, you'll have over $2.3 million. But here's the critical thing. This only works if you don't lose money. If you have 1 year where you lose 20%, it takes much longer to get back to where you were. A 50% loss requires a 100% gain to get back to even. A 75% loss requires a 300% gain. This is why risk management is so important. Professionals protect their capital first. They make returns second. They know that if they can make 15 to 20% per year without any big losses, they'll be incredibly wealthy over time. So they don't take huge risks. They don't try to make 50% in a month. They focus on being consistently profitable. And most retail traders have this backwards. They're trying to make 50% in a month. They're taking huge risks. They're risking their account on one trade. And when that one trade goes wrong, they lose everything. Then they have to start over. They have a tumak, 100%, just to get back to where they started. It's a game they can't win. So what does all this mean for us today? Okay, so we've covered the big secret. The rule that separates winners from losers is position sizing, expectancy, and discipline. But what does this actually mean for you? How do you actually apply this? First, you need to stop trying to predict the market. I know that sounds weird, but most retail traders spend all their time trying to predict what the market will do next. They're looking at charts. They're reading financial news. They're trying to figure out if the market is going up or down. And this is a waste of time. Even professionals can't predict the market accurately. Instead, you need to focus on finding a system that works. A system that has positive expectancy. And here's how you do that. Step 1. You backtest a strategy. You can use simple websites for this. You don't need expensive software. You look at historical data. You look at a strategy. You see if it would have made money in the past. Let us say you want to test a strategy by when the stock goes above its 50-day moving average and sell when it goes below it. You take the last 5 years of data on a stock. You run that strategy on it. How many times would you have bought and sold? What would your profit have been? Step 2. You calculate your expectancy. Over all those trades in the historical data, what was your average win? What was your average loss? What percentage of trades were winning trades? Now you have enough information to know if your strategy would have worked. Step 3. You paper trade. You follow that same strategy with fake money for 2 to 3 months. You don't use real money yet. You just follow the rules with fake money. You see if your historical results match your real results. Usually they don't match perfectly because the market is different now. But if you're close, that's good. Step 4. If your fake trading looks good, you start with real money. But you start small. You only risk 0.5% of your account on each trade. Not 2%. Not 3%. Just 0.5%. This is small enough that you won't hurt yourself if something goes wrong. But it's real money, so you'll feel the emotions. Step 5. After you've traded with real money for 2 to 3 more months and you're still making money, then you can increase your position size to 1 or 2%, but only if you're still making money. This entire process takes 6 months, maybe even a year. And most retail traders will not do this. They don't have the patience. They want to make money now. But this is exactly why most retail traders lose money. They don't have the patience to do it right. But here's the amazing part. If you do have the patience, your odds of success are much better. Much, much better. You're not guaranteed to make money, but you're following a process that professionals use. You're stacking the odds in your favor. Now let's talk about the bigger picture, because this applies to more than just trading. This principle works in any area of investing. If you understand expectancy and position sizing, you can apply it to real estate. You can apply it to your business. You can apply it to anything. The principle is always the same. Don't risk too much on any one thing. Understand your odds. Know what to expect over a long time. And don't change your strategy when you hit a rough patch. But there's something else that's really important here. And this is where most people miss the bigger lesson. When you follow these rules, you stop playing a game against the market. You stop trying to beat other traders. You stop trying to time things perfectly. Instead, you become a business owner. You're running a trading business. And like any business, you track your metrics. You know your numbers. You're making consistent decisions based on data, not emotions. A restaurant owner doesn't get excited and put all their money into one promotion. They test promotions. They track which ones work. They scale up the ones that work and cut the ones that don't. They're following a system, and a trader should think the same way. This shift in perspective is massive, because suddenly, trading isn't about getting rich quick anymore. It's about building a business that generates consistent returns. It's about discipline. It's about following the rules. And here's what's wild. The traders who make the most money are the ones who don't obsess about making money. They obsess about following the rules. The money is just a result. It comes naturally when you follow the rules. Now, you might be wondering, okay, I understand all this. Position sizing, expectancy, discipline. But where do I start? What's the first thing I should do? The answer is simple. Start small. Start with paper trading. Download a free charting platform. Most of them have backtesting features. Pick a simple strategy. Test it on historical data. See what your expectancy is. Then paper trade it. Don't risk real money yet. Just follow the rules with fake money. Most people won't even do this step. And that's fine. You're already ahead of them just by understanding this stuff. But if you want to actually trade, paper trading for 3 months is a good start. It costs nothing. It teaches you discipline. It shows you if your strategy actually works. Another thing to understand. This isn't guaranteed. Even if you follow all the rules, you might still lose money. There's always risk. There's always uncertainty. This strategy improves your odds. It doesn't guarantee success. You need to understand that before you start. Also, taxes are real. Face RL slippage is real. Those things eat into your returns. When you backtest, you can sometimes ignore them, but in real trading, they matter. So your real results might be a little bit worse than your backtesting results. That's normal. That's expected. Before we wrap up, there's one final thing you need to know. There's one more discovery that ties everything together, and it's something that most traders never learn. It's about what researchers call survivorship bias. Here's what that means. When you look at successful traders, you're only seeing the ones who survived. You're not seeing all the ones who failed. A guy makes 100% profit in a year and gets famous on YouTube. Everyone celebrates him, but you don't see the thousands of other traders who tried the same strategy and lost money. The ones who survive, the ones who become billionaires and famous traders, are not always the smartest people. They're not always the most talented. Most of the time, they survived because they followed the basic rules. They managed risk. They had discipline. They didn't get wiped out. Think about it like this. If 100 traders all follow the same strategy, but they manage risk differently, the ones with the best risk management will survive the longest. And over time they'll have the most money. Not because their strategy is better. Not because they're smarter. Just because they didn't blow up their account. This is so important. Success in trading is often about not failing. It sounds backwards, but it's true. If you can avoid the catastrophic losses, if you can stay in the game long enough, you will eventually win. The odds catch up. Compounding takes over, and you become wealthy. But the traders who don't manage risk, they have amazing strategies that could have worked. They could have been billionaires, but they blew up. They lost their entire account on one trade, and they're done. They're out. They have to start over from zero. So the real rule, the rule that most retail traders ignore, isn't really about finding the best strategy. It's about survival. It's about not blowing up. It's about staying in the game long enough to win. Let me bring this back to where we started. Remember that statistic? 90% of retail traders lose money. Why? It's not because they picked bad stocks. It's not because the market is rigged. It's because they didn't follow the rules. They risked too much on one trade. They didn't have positive expectancy. They didn't backtest. They quit their strategy too early. They got wiped out. But 10% of traders make money. And you know what they all have in common? They follow the rules. They manage risk. They have discipline. They don't get emotional. They understand that trading is a business, not a game. So here's what I want you to take away from this video. If you want to trade, don't start with real money. Paper trade first for at least 3 months. Maybe 6 months. Learn the discipline. Learn to follow the rules. Then, when you do start with real money, only risk 0.5 or 1% per trade. Find a strategy with positive expectancy, not by trying to predict the market, but by looking at historical data, by understanding the math. Then follow that strategy, even when it's not working for a few weeks, because most strategies have drawdowns. Remember, compounding works. Making 15% per year consistently will make you wealthy over time. You don't need to make 50% in a month. In fact, trying to make 50% in a month is probably how you'll lose everything. This is the rule that most retail traders ignore. This is why the professionals win while the amateurs lose. It's not magic. It's not luck. It's not secret information. It's just math. It's just discipline. It's just following the rules. And here's the beautiful part. Anyone can do this. You don't need to be a genius. You don't need to go to an expensive school. You just need patience and discipline. If you have those two things, you can trade like a quant. You can follow the rules that billionaires follow. You can stack the odds in your favor. The question is, will you? Will you have the discipline to paper trade for 3 months? Will you have the patience to backtest your strategy? Will you have the discipline to only risk 1% per trade? Or will you be like the 90% who lose money? The choice is yours. And now you know the rule.